Thank you, Jenny, and thanks for the introduction. And good morning, ladies and gentlemen. Well, I must start by saying thank you to AgriFin, the World Bank, for the invitation. I think it's always a pleasure to attend your conferences. Well, and I think clearly one goal is to attain the goal of exchanging knowledge and information. And there is always a learning in every session that we have. And I must also compliment the previous speakers because I think they have covered everything. Especially if you think of Florence, I would say I probably don't have anything to say. I should say, oh, it's very similar to what equity is doing. I think I should have a seat and let you know that, yes, I think equity is doing a very good job. But I must say that all the presentations we've had so far have been very good. And I think it teaches us that financing agriculture, we have got to adapt based on what environment we're working in. There's never going to be a model that is going to work for everyone. The benefit that we can give as an experienced business within agriculture is to say, we've tried that, and these are the hurdles you're going to find. And I think I'm going to try and make that the main objective in whatever I present, is more of highlighting what the challenges are. I must also comment that while I've been introduced as head of ABSA Agribusiness Africa, on the 31st of July, we had a change in terms of the trading, and we're now Barclays Africa, because Barclays is the majority shareholder. So that's why you see the presentation appearing as Barclays. But I think this is part of the process that we've gone through. As a business, we're present in 12 countries, and predominantly, you'd say Southern Africa. We're present in Ghana, West Africa. We have a representative office in Nigeria. We're also present in Egypt. And all businesses are now owned by Barclays Africa, except the Egyptian operation and Zimbabwe, due to a number of challenges that are faced in those markets. But overall, all these businesses are managed from South Africa, from Johannesburg. The one to take note of is we have Tanzania with 2 colors, and Tanzania has 2 colors because we have 2 businesses that are present in Tanzania. We have a Barclays, and we also have a National Bank of Commerce in Tanzania. And those are 2 businesses that we support, but the 2 businesses are in direct competition within the Tanzanian environment. In South Africa, as Jenny touched on, we have a total exposure to agriculture that's across the value chain of about $3.5 billion US, and outside the rest of Africa is about 1.5. So collectively, we're looking at an exposure of about 5 billion. Unfortunately, within South Africa, the bulk of our exposure is to established commercial farmers and businesses. We have a responsibility in terms of South Africa's redistribution to support emerging farmers, predominantly black farmers. And that is an area where they're still working on that faces a number of challenges very similar to the bulk of Africa, at times even more complicated because you're dealing with well-established value chains. Our exposure to the emerging agriculture is at about 3%, and not more than that. And one of the key challenges that we've learned within agriculture is that you need a strong agribusiness analysis or research team, and we run a team of about 45 people that are responsible for agriculture to support the entire business. Here I'll just highlight the products that we have, in that we have them varying from what we have described as highly complex and to what we would say low level of complexity. And predominantly what we have running in Africa are the products that we have of that are not very complicated, while our corporate clients will be using more complicated products. Within South Africa, the advantage that we have is that we have a well-established futures exchange dealing with commodities, especially dealing with maize, soybean, and sunflower, and those were able to create a product that would refer to as an input cost insurance finance, where the farmer hedges the product, and once he's hedged these products, it basically has an indication of what his minimum price will be, and is able to obtain insurance at planting, and we're able to finance using that product as part of the security. What I've highlighted at the bottom here is coming out of agribusiness and showing that agribusiness as a unit supports the business across all sectors of the bank. In terms of segmentation, we're looking mainly at the type of products that we use. So we have, for example, savings, check account. You look at the debt products. As agribusiness, we don't necessarily own a product, but we help modify and adopt the products to fit into other areas. And that I see as one area that actually you would see as businesses, as you continue to grow your agribusiness exposure, that within a business you start facing challenges, because as an agribusiness unit, you're referred to as not owning the customer, but you also don't own the product. but you help the rest of the business adopt these products to fit the needs of the customer. And it is within that environment that you find that as an agribusiness unit, you're always in a state that changes, meaning that you could be, once the business is doing very well, performing well, non-performing book is shrinking, everyone believes they can do agriculture, and probably then they wonder why they actually have an agribusiness unit. But when the market conditions change and the non-performing book is growing, then you're everybody's friend, because everyone wants to hear from you what to expect and what are the challenges that, that you foresee within the market. So broadly, I would say that our lending is really determined by what we determine as our mandate and scale, which really outlines what our appetite is. And I'll probably use the South African as an example, that would then have a limitation in saying that, say, within South Africa, our total exposure for agriculture cannot exceed, say, 7.5% of total assets. But once we've also done that, we then have to subdivide the country based into regions and split out what to try and work out a concentration risk that we can carry, which then based on regions, which have some specialties. Some you'll find are growing deciduous fruits, some are more into the grains. And then we also have then limitations within each sector in terms of what is the maximum exposure we could have, for example, into maize. And once we have that, we also then have a maximum exposure we can have per client. And when it comes to looking at structuring of our products, then the key question is really looking at the entire product range that we have, but also trying to work out to ensure that whatever solution we provide with the client is really meeting the client's needs, be it short-term or long-term. And short-term, that would touch into the area that was really covered very well earlier, which is going to be a seasonal credit. And then in long-term, you'd say that we look at our maximum tenure is going to be 10 years, but under special circumstances, we could go up to 15 years, though we don't encourage that. And the reason why we don't really encourage that within the South African environment is that the pricing starts becoming a bit of a challenge, trying to price over a 15-year period. In some of the other countries, our experience has also been that the limitation is mainly based on legislation. For example, you cannot give a term loan in excess of 7 years, and therefore you've got to structure the product within a 7-year period and be creative in terms of how that comes out and how that could work. And the other would be around the availability of credit. I will touch on, I think as we go through the presentation, I'll touch on the issue of how we overcome the 10-year period where we need to provide longer term. The other really touches around the assessment, and I think that was really touched on yesterday with the ALICE model, and I'll highlight some of the pieces that we do in doing that, in that that's what we do, and we look at it mainly from a cash flow analysis, and where we look at the affordability or viability of the business activity. The other aspect that we look at is looking at the economy and market expectations. Where do we expect the market to go in terms of price expectations and costing? And of course, the other is the value we attach to the collateral that we'll take. And what we do to govern or manage the collateral is that we have a set of valuers who are approved valuers for the agricultural assets, but we also sit with the valuers and give them what we'll describe as guidelines. And in establishing the guidelines, we have what we describe as a panel. And in this panel, we then all sit together looking at a panel which would include the valuers themselves, the farmers, property dealers or sales personnel, and we look at what the trends are and what's really driving the prices. And in doing that, we then establish what would be broad guidelines of what should be the value. And meaning that while a non-accredited valuer would probably most likely would value the agricultural land a lot higher, you'd find that in our guidelines, it might be valued lower, and that's purely trying to protect and ensure that once we have a forced sale, we're able to recover the full value of the loans. From looking at the debt products that we run for agriculture, and as has been touched on, it's really going to vary based on it would be the nature of the collateral that we're going to take. And if we're looking at your fixed assets, really the key question is going to be, that will guide us would be what is the productive life cycle or life of that asset. If you're looking at land, you would say, of course, it's well over 10 years, and therefore that we could cover under the 10-year period. But then the other limitation we would have is that we'll look at our loan to asset value, and this will vary between 50 and 70%. But it could also be higher than the 70% based on the viability of the business that you're looking at. You could have very strong cash flows, and that we could then look at 80% or 90%, but most common practice would be in the region of between 50 and 70%. Then there was one, the other would be the one I touched on, which could be based on the commodity, which is linked up to a futures exchange where we have a fixed market. In the process, we've established a floor price, or the commodity has been hedged. And that we're able to establish what the value is. And for that, we're able to lend or provide working capital that will be up to about 60%, 65% of the expected value of that crop. But that crop has got to be insured, and it will be backed by insurance. The farmer has got a reasonable track record to expect him to meet all the insurance obligations, ensure that the insurance remains valid. The other bits where we have is looking at or exploring ways to improve our relationships with agro-industries, and in improving the relationship with agro-industries is to work out how best to provide solutions that will help them meet their needs, and that's mainly around their clients, those who are producing for their offtake, so that we're then able to provide credit solutions that are tailored to those agro-industries. And those could be, for example, and here I've got an example of sugarcane. And the sugarcane, in this case, we have examples of the land reform or land redistribution, where land has been passed on back to the previously disadvantaged. And as part of the transaction, the government has a condition that that land cannot be sold. So basically, the community takes over the land, but that asset can never be sold. So we've got to look for another creative way on how you actually finance that. So what we then did was to have a relationship with some of the sugar mills, where the sugar mills have created management companies with the communities, and they have long-term leases. I think one of them has a long-term lease in excess of 25 years. So we're able to take that long-term lease as a security that we would work with, but also based on the fact that there's a joint venture that is managing the farming operation. And that gives us a comfort to continue to transact with them as if we have the normal collateral. In terms of the repayments, I think our biggest differentiator here is going to be linked up back, as was touched on earlier. It depends on the kind of commodity or product. And the question then is, can the client manage monthly payments, or would the client be more comfortable with biannual payments or a single payment? And we could also work it out with a residue payment or a balloon payment at the end of the period. And this tends to come in handy where you're looking, for example, at a sugarcane establishment where the client surely requires 10 years minimum to finance the development of the sugar plantation, but you find that there is a limitation in that you can only lend over a 7-year period. So what we do in such a circumstance is to build in a balloon payment at the end of the 7-year period, and at the end of that period, we will reassess for refinance to see whether we can then finance the other period that continues. I think the other interesting bit that comes on if you look at sugarcane would also be that in the process, we've got to consider the replanting that has got to take place within the 10-year period, so that you then start factoring that in around year 7 to ensure that the farmer then is starting to replant, so that that is taken into account as we model that bit. In terms of the monitoring and product development, I think we tend to run hand in hand. The monitoring is the responsibility of the relationship manager, where the relationship manager is responsible for the day-to-day management of the client or for the account. But of course, he or she is also assisted by the system, in that we then have system-based triggers, which could highlight if an account has been overdrawn, if the account is in arrears, and having it progress through the systems that are there and saying that either it will be moved on onto an early warning list, meaning that it's going to require special attention and monitoring to ensure to understand why is this account falling behind and why isn't it in line with what were the projections. All our accounts, irrespective of size, if there is debt, have to go through an annual review process, meaning that every year, if you're going to renew, if it's a long-term debt, your account's going to be reviewed, even if your account is not yet due to be settled in full. And so this goes hand in hand with looking at your short-term requirements coupled with your long-term requirements. And we would also run special review processes when an industry comes under pressure. Say, for example, if we have a flood, say, in the northern part of the country, then we sort of institute an immediate review of all accounts to ensure that they're all in line and can continue to meet their obligations, or understand those that might require restructuring due to the conditions that have changed. In terms of the product development, I think here our key focus really has been on strengthening the use of, or trying to increase the use of soft commodities as security, and to improve our finance across the value chain. And of course, this is dependent on the futures exchange and the building of insurance products. In that, ensure that we do this properly, we have to have better insurance. We're finding that there is a growing challenge, even within the commercial space of insurance products. The appetite for reinsurance is shrinking, and probably that's the one element that you could say there is need to find a way in which we collaborate with the developing side of agriculture and the highly commercial side of agriculture, in that the highly commercial side of agriculture has become very uniform, such that when we have a disaster within the maize growing areas, it's actually widespread. It covers a bigger area, and therefore the risk to the insurer is becoming bigger, thus a smaller appetite for reinsurance. Though our current thinking is that if we're able to increase our emerging agriculture and the development agriculture, plus growing insurance across Africa, we might have greater diversification and therefore increase the appetite within the reinsuring community, business community. The other, of course, is looking at our arrangements with the offtake, which could be, and this is really around the larger corporates, and getting them to accept to give contracts that really specify the quantity, pricing, and the pricing giving a variation, a variable in that you're able to give an indication of what your likely minimum price is, but also how the clients or farmers would benefit from a rising market, so that you minimize the diversion of commodity or minimize the side selling, because side selling will be basically driven by slightly higher prices. And of course, our continued development also sits around cost reduction, and that's we driving to drop our costs, but also encouraging the farmers to look for other ways in which they will drop their costs to remain profitable. And the other is the better understanding of risk and how we are defining it for our internal management and how we mitigate that. The other is also that of looking at our target clients and looking for the different solutions that we have for both those that carry weak, what we refer as weak balance sheets, and the strong balance sheets. But what we also continually learn is that every transaction is a learning exercise. Even with the several years of history and transactions that we do, is that we continually learn of new risks and what challenges we've got to adopt ourselves to. And the other is also a better understanding that we've also got to build a high degree of flexibility in how we manage our processes. And that's one message I would want to give, especially as, like yesterday we had a discussion around the presentation around Alice. The question is, you have to try and make sure that you keep your system as flexible as possible and allowing it to shift as quickly as possible. Because in some circumstances, some parameters will not work the way you expect them to work. And I think here I've carried an example of the East African region. We comfortably finance sugar, the sugar mills, but as happened earlier this year, there were high imports. The imports were cheaper than locally produced sugar. Therefore, the sugar mills were sitting with high levels of stock. To a bank, the clients were out of their normal parameters, and the result would be that we're supposed to actually hold back and try and freeze our exposure. But the question was having to understand that market and knowing that we've got to be a bit flexible in that there were changes within the market. But the key question is then also looking at how do we support the clients to lobby governments better and try and get better control or better understanding and influence the governments not to allow imports that would exceed the local production. But that happens in an environment that is controlled like sugar. So you'd find that you have similar challenges in other sectors where there's less control, less influence that you can have as a client. In terms of our assessment, this really, and this I would say stands back to more or less what we had yesterday from an ALES perspective, in that all our clients, if there's an agricultural exposure, the assessment has got to be done on, we start off with a cash flow analysis, and this has got to be built on a monthly basis, that we then look at what are going to be the monthly trends. And the key aspect that we look at would be, for example, a cash flow ratio, and which would basically be all your inflows versus your outflows to ensure that we're comfortable with what is being turned out within the business. And ultimately is that all inflows and outflows within the household or the farming operation would have to be included in the cash flow. Meaning that if the farmer has obligations to pay, for example, school fees, we've got to see how we build that in to ensure that the farming operation is able to cover that. If the fees are paid from some other income or dividends from other investments, we've got to build that inflow into this cash flow as well, so that we are clear that the cash flow, while we're looking at agriculture, has inflows that are outside agriculture, and we combine them with the agricultural cash flow so that we're able to have a good understanding from an affordability perspective. And in essence, what that is building is trying to build this, trying to make sure that the cash flow is giving us this understanding, This could be annual or this could be monthly. The start-off point that we have is really building that on a monthly basis. This tries to depict that we've got to include all the other overheads, including his living costs, as being a point that's also got to be covered. And we'll have this assessment for both the short-term and long-term debt, so that at the end of the analysis, we're able to tell how much debt, both short-term and long-term, that this client can qualify for. What I've done here is take an example of a summary that we'll pick from our analysis. And this was a startup for an experienced broiler farmer starting up a hatchery. And the key that's going to be provided by the agri-specialist would be that he's going to highlight the experience of the farmer, the broiler farmer, what are the industry trends, the interlinkages between the economy and the market trends, and then, of course, a detailed analysis of the client's business plan. And in this, you would have the long-term debt already built into the outflow. The interest going out would be linked back into the outflows that are taking place. But unclear, this would help identify. One will give you what would be his, say, the closing balance. Will have what would be the worst balance and what would be the best balance. That will give us, and this is done on a monthly basis, and that's why you see we have a month there. In that case, it's June 12. That will highlight that was the close, the end of his financial period. What was the worst balance? It happened on June 12. What was the best balance? It was on August 2011, meaning that in this case, based on, if you look at the long-term debt that is required, plus he will have a shortfall of about, in this case, 5,600, and we then factor it in with a multiple of about 10% and say that ideally the maximum limits that would be tolerated in this case would be the worst balance of 5,600 plus a 10%. That will give us a projected worst limit, and that would be a projection of his working capital that would be required over and above the funding that he requires for his fixed assets. We'll then look at the cash flow analysis that would have, in this case, he has a 93%. We describe that as being poor. He has 111%, still described as poor because ideally we're looking for about 120%, and at 130%, we describe that as excellent. In this specific case, it was still supported purely based on the declining trend, for example, would have, or an improvement in the cash flow ratio, and the fact that he was able to service the full debt while also dropping the worst balance that was required, that's dropping. And I think that's one thing that we then have running with each of the applications. For everyone that requires a credit need, that is done. But it could vary based on the size or scale of the operation, but I think we make it our point to understand what are the flows over a 12-month cycle. And we see that as being quite important. From a monitoring perspective, in this case, if we have had a projection that the worst balance is going to be in June 2012, and the client's worst balance happens in April, that triggers an event in that there's going to be a reassessment of what happened, where the cash flow projections wrong, or what has changed within the market to make the necessary adaptations to ensure that the client does not run into trouble going into the future. It helps us identify the problems a lot earlier. Where the problems have not been severe, when it comes to an annual review, any other problems are picked up because the agri-specialist has got to match the new cash flow with the previous cash flow and highlight where there have been substantial variations. Well, we touched on that. And this is just to highlight previous diagram which had more stable payments. This you would say probably would depict something like sugarcane, where you're going to have costs taking place and only a payment towards the last 3 months of the financial year for that specific client or after a 12-month period. And this is where you'd have to adjust and make sure that your payments happen either you have one single payment in a year, but you've got to ensure that this farmer is still able to afford the single payment that's going to take place while he's also continuing to meet his living expenses that are required. In terms of, I'll come back to the valuation of the assets because we find that as being very important. I think the key goal here is to really find a way in which we minimize our losses should an account be called up. And it's one way of saying that we've got to look for a way in which we manage the value. And within South Africa, I would say that, yes, that one we're succeeding quite well. But I would say outside South Africa, within the African setup, we still have a big challenge in how we manage or improve our valuations. The other would be that in terms of our management of our accounts, we have a business support area that supports any accounts that are finding difficulty, and this would fit in with the normal bank process in that we don't have specific differentiation for agriculture. And after 90 days in arrears, an account will be passed on to business support. And once it's passed on to business support, we have a detailed assessment, one from the credit team and from the agricultural specialists, to see how best to support the client, and the goal being how do we ease the pressure within the business and what are the challenges the business is facing. We'll have an agri-specialist involved, one to provide the agricultural background and also engage or support the team, the credit team and the relationship manager as they have the discussions with the client to establish what are the challenges this client is facing and what other changes can be made to support the client to ensure that he or she continues to service the debt. Does it require restructuring, and would restructuring help, or would restructuring cause more difficulty? But the goal in every sense is to try and minimize the call-ups that we have. Being agricultural, the more call-ups, for every call-up you carry a risk that you might actually not be able to recover the full lending. And the question would always be to try and see how you support the business and try and resuscitate it as opposed to following up with legal action. Thank you, ladies and gentlemen.